let's just start big picture. We have high inflation, Fed saying that it remains committed to getting inflation under control. Markets are bracing for what's next. What's your assessment of where we stand today?
I think you sort of summarized it. Everyone's talking about the last CPI report. Obviously, we're 8.2% inflation in the United States here. A totally unacceptable number, a number that really hurts consuming Americans and it's really regressive inflation. So you understand from the Fed's standpoint, they have to tackle inflation. They have a blunt instrument. They have a blunt instrument, which is interest rate policy at this point. They're trying to increase rates. They're trying to increase rates to slow demand down, to take demand out of the economy. They really cannot affect the supply side of the equation. The problem that we have, or the issue that people are debating now, is the Fed started raising rates earlier this year. We've gone through quite a few interest rate rises already, and the economy has not slowed down from an inflationary standpoint. That said, we all know that this monetary policy takes time to feed itself through the economy. Unfortunately, it hits consumers almost immediately. So if you've got an adjustable rate mortgage, it adjusts the next day. If you've got credit card debt that adjusts, it adjusts the next day. But the real policy effects on slowing down demand, that takes months and almost a year to a year and a half to feed through the economy. So there's this discussion going on. Has the Fed done enough in interest rates to slow down the economy? And we don't know because the effects are still being felt of the first rate increases, or have they not done enough because we continue to see inflation move higher and higher? So I think the Fed is in a very difficult position. They were late to the game. They started raising rates late, which means they're now playing catch up. I think we all believe that they will raise rates 2 more times this year at the 2 more meetings, probably at least 75 basis points in the November meeting, and probably another 50 to 75 basis points at the end of the year. So we will have gone from basically, 0 Fed fund rates in the United States to well over 4% rates in the course of a year. That's a fairly dramatic move. And we need to understand what impacts that's going to have longer term to the economy.
And what impacts do you think it could potentially have longer term? And are we going to be able to do this without going into a recession?
Well, the question is, what are the impacts? And as I said, the Fed can try and affect demand, the demand side of the equation. They can make borrowing money more expensive. They can make homes more expensive. They can try and slow consumers down because things are harder to buy because they don't want to finance them. They can't affect the supply side of the equation. And right now, when you look at the data and you look at what's going on in the inflationary front, a lot of the inflation comes from commodities and commodity inputs. So by raising interest rates, we don't create more oil. We don't create more food. So we're trying to create a balance of oil. We're trying to create a balance of food. We're trying to create a balance of workers back into the labor force. I think one of the big underlying components of inflation is wage price inflation. We keep seeing 5+% wage inflation. Wages filter through everything we do. As the economy has shifted during COVID to where we're buying lots of goods because we really couldn't leave our houses, so we were buying things, we were having them sent to our houses, and we were consuming goods. We're now back into a more normalized economic cycle. And in a normalized economic cycle, we as Americans, we're good consumers of services. We like to go out, we like to be entertained, we like to travel, we like to go to events. The service economy is all labor. When you go out to a service event, you're really buying mostly labor. So when you go to a concert or you go to a restaurant or you go to a bar, you're buying some inputs, some commodities, but you're buying an awful lot of labor. That labor cost has not come down. And it's another area where the Fed is trying to get some response. They're trying to get businesses to not grow as fast. They're trying to get people businesses to not hire as many people. But we saw even in last month's unemployment report, we saw 3.5% unemployment. We still see non-farm payrolls growing. So the interest rate impact has not fed through to the business cycle yet. We're going to have to see job destruction if we're really going to see inflation be curtailed. And I think that's hard because we've gone through a lot of fundamental changes in this country. Prior to COVID, we were all talking about the aging American workforce. Guess what? We're still an aging American workforce. We didn't stop aging during COVID. Unfortunately, during COVID, we lost about 2 million people from the labor force, either through long COVID or unfortunately they passed away, which is a horrible event, but we've got to recognize we've lost people from the labor force. And then we had a bunch of people sort of late in their work cycle who decided to leave the labor force. So we now have a smaller labor force population in the United States. So businesses, to attract workers into the labor force, are having to pay more to get workers into the cycle, which is inflationary. Wages go up. They pass those increased wages on to the consumers, and we're in this inflationary cycle. So the Fed's going to continue to keep raising rates to try and break this cycle. They won't know they have broken it till long after it's broken.